In continuation with retirement corpus investment, today's topic would be equity mutual fund. Equity mutual funds are riskier, but they form an important part of the overall investment portfolio to generate higher returns. Without taking undue risk, if invested wisely, the equity mutual funds can give you much higher returns. The question here is, how does one select an equity mutual fund? The mutual funds have become the most popular form of investment because they are easy to operate, simple to understand, and gives enough flexibility to the investor to move in and out at any given time. Today, the mutual fund space is crowded by about 1600 funds, a daunting task for an individual investor to select from. Today, we are going to help an investor how to navigate through this maze of fund selection. As the name suggests, equity mutual funds invest in equities and equity related instruments. SEBI has classified equities into three main categories, that is large cap, mid cap and small cap. The easiest way is to select a fund which is investing either into large cap equity or mid cap equity or a small cap equity, depending on one's risk appetite. Going further, there is a category of funds known as multi-cap funds. The multi-cap funds invest across all the three categories in different proportions. They provide you the benefit of each category. There is no classification as per any regulation, but in our opinion, the multi-cap funds can be divided into two types. One is aggressive multi-caps and the other is conservative multi-caps. The aggressive multi-cap funds are the funds which invest about 40% or more of their corpus in small and mid cap equity, whereas a conservative multi-cap would be a fund which has 70% or above exposure to large cap equity. These funds have a superior returns and they cushion the risk substantially because of their investment in all three categories. There are two more categories which I would like to discuss here, and these are, one is equity linked saving schemes, what is popularly known as ELSS. ELSS function like a multi-cap fund. However, since they give tax benefit, there is a lock-in period of 3 years. The lock-in period of 3 years gives the fund manager a chance and the benefit to take long duration calls because he knows the fund is there for 3 years, and that's why these funds give higher returns than the normal multi-cap fund. The other fund in a multi-cap category is the focused fund. The focused funds have less number of stocks, about 25 to 30, as compared to 50 to 60 stocks in a normal multi-cap fund. So here it is a concentration of portfolio which leads to a high risk to reward ratio. These funds are suitable for higher risk taking investor. All these 5 categories of funds, that is the large, mid, small, multi-cap, ELSS and focus funds, add value to your investment corpus. They provide higher returns and you are not exposed to unnecessary risks. We have spoken only about 6 categories. So what do we do with 1600 funds which are there in market? Majority of these funds are sector funds, thematic funds or value funds. They are basically same wine in different bottles. Please try and understand that the equity markets are cyclic in nature. One sector goes up, the other sector comes down. Certain themes are doing well at one time, they may fall at the other time. Take for example, at one time the pharma sector was doing well, the other time the .com sector was doing well, sometimes the infrastructure does well. So their returns are cyclic in nature. An investment manager or an investment advisor generally advises when to enter the fund and not when to exit the fund. If a sector or a theme is doing well, a good manager from a multi-cap fund will move a large investment into that sector or that theme. However, when that sector is fallen out of favor or the returns dip in that sector or that theme, the fund manager of a multi-cap fund has the flexibility to move out his investment from that fund. When a sector or a theme falls out of favor or its returns fall, a multi-cap fund manager has the flexibility to move out his investments from these funds, whereas a fund manager who is specific to a sector or a theme will be stuck in that investment. He has no flexibility to move out the funds. This very nature leads a cyclic return in sectoral or thematic funds. They may give high returns for a short period, but thereafter their returns will be of very low nature. It would be prudent for risk averse investors to stay away from these specific sectoral or thematic funds, as the volatility of these funds is very high.